Hey guys, more taxes are expected as the UK Chancellor Rachel Reeves prepares for the October budget. The question is which taxes are expected to increase? How do they affect your personal finances, and what should you be doing right now in order to prepare? I plan to give you the answers to all those questions in today's video. Now, you may remember that when we had the elections in the UK, that Labour won the election. One of their key messages was that they would not increase taxes for working people. However, once they won this election, all of a sudden, out of nowhere, they found a £22 billion black hole. And it's been hinted that this £22 billion black hole is actually not a one-off amount. It might even be a permanent yearly amount. And as a result of that, we all now need to make difficult choices in order for them to fix or plug this hole in the public finances, which means that whether you like it or whether I like it or not, we are gonna have to pay more taxes in one way or another. So for today's video, I want to just unpack what the options are, what have they said they will not charge us taxes on, and what other taxes could they potentially explore as a way to effectively fix the public finances or raise the money to plug this hole. Now, if you're really enjoying today's video, I'd appreciate you just taking a moment to hit the subscribe button down below. My name is Ken Okorafor. I am a chartered accountant, former CFO, and I'm also a financial coach. Together with my wife, Mary, we run the Humble Penny and Financial Joy Academy. We're also Sunday Times best-selling authors of our debut book titled Financial Joy, a 10-week plan to help you banish debt, grow your money, and unlock financial freedom. I'll link to it below as well as above for anybody who wanted to learn more about it. Well, let's jump straight in. Now, I wanted to start with the bit that appears to be the good news. And I'm quoting here something that Rachel Reeves said recently, and I'm quoting the exact words. I believe this happened at the Labour Party recent conference. And here are the words she said. She said, "My budget will keep our manifesto commitments. Every choice will be within a framework of economic and fiscal stability. You'd expect nothing less," she says. Then she said this in particular. She said, "We said we would not increase taxes on working people, which is why we will not increase the basic, higher or additional rates of income tax, national insurance or VAT. In addition," she said, "we will cap corporation tax at its current level for the duration of this parliament." So if we're going by the words of the Chancellor, it means that we will not expect any increases in these various areas of taxes that she's mentioned. However, what she's not said is that we shouldn't expect increases in other areas. So for example, apart from the areas she's mentioned, we may expect increases in capital gains tax, inheritance tax, for example. They may make significant changes to pensions, and they may also continue some of the stealth taxes, some of the difficult taxes we've been experiencing via income taxes so far. So for today's video, I'd love you to please be patient because I want to run through various scenarios of what things might look like. Now, one thing I want to share up front as a way to reassure you is please do not make any hasty decisions on the back of what I'm going to share on today's video, because you need to first of all, do some research, seek some advice, and some changes you might make might be ones that are, ones that you can't reverse. So think very wisely before you make any changes and think long term. So the first area of tax is capital gains tax. For those who don't know, it's tax payable on gains on assets that are outside tax wrappers, for example, an ISA, for example. If you generate gains on those, you pay capital gains tax. Now, with capital gains tax or CGT, the areas they might actually try to make these changes or raise money from are, number one, is to cut the CGT allowance of £3,000 a year as at the moment. Number two is that they may change the capital gains tax rates, and I'll be going into that in a moment. And the third is that they may change what happens on death when it comes to capital gains tax. Okay, so let's look at the first scenario, which is capital gains tax if the rates are changed to match income tax. Yeah. So at the moment, the basic rate taxpayers pay a capital gains tax rate of 10% on gains made outside of residential property, compared to income tax rates of 20% at the moment. That's basic rate. Higher rates and additional rate taxpayers pay a 20% on gains for capital gains tax. They pay 20% on gains outside of residential property, compared to their income tax. They might pay at 40% and 45% respectively for additional rate taxpayers. Now, the way they might do this is that the Chancellor may actually choose to align the capital gains tax rates with income tax rates. So I'm going to use an example. So let's say that you have, you've got some investment and you've made a £30,000 capital gains by investing, say, in stocks and shares outside of your ISA, for example, maybe in a general investing account. And after the £3,000 allowance that you get per annum, you now have £27,000 as subject to CGT. A basic rate taxpayer at the moment will pay a 10% CGT tax on that money, i.e. £2,700, and an additional rate tax, an additional rate taxpayer would pay 20%, which is £5,400 in that scenario. However, if the rules were changed such that CGT matched income taxes, and let's assume that the allowances remain the same, then a basic rate taxpayer will go from paying 10% to paying 20%. So they'd pay $5,400 in that scenario. And a higher rate taxpayer will go from paying 20% CGT to paying 40% CGT. So they'd be paying £10,800 in that scenario. And an additional rate taxpayer will also go from paying 20% to paying 45%. So they'd be paying £12,150 in that scenario. Effectively, if they made this change, aligning capital gains tax rates with income tax rates, everybody at all income levels, basic, higher rates or additional rate taxpayers, will be paying a lot more significantly if they crystallize gains outside of an ISA, for example. The second scenario when it comes to CGT is if the rules on death changed. So sticking again with a £30,000 example where we've made gains of 30k in, say, stocks and shares, for example, outside of an ISA, assuming you've made a gain outside your ISA during your lifetime, for example, and let's say you give the assets away on death. Let's say somebody passed away and then their assets passed on to a loved one. There are currently no capital gains at all to pay, as effectively that will fall under a different type of tax, which is inheritance tax. However, they could change the rules so that there would be CGT, capital gains tax, to pay on death. So in that example, if, say, you are a higher rate taxpayer and, God forbid, you passed away or a family member passed away, if they were in that scenario, and if the CGT rules were changed so that you now have to pay on death, for example, then the tax, and let's assume that the tax rate remains the same at 20%. And let's say you've used your annual allowance or £3,000, deducting it from that £30,000 gain you made, you would have £27,000 that will then be subject to capital gains tax. And then when you apply the 20% capital gains tax rate for a higher rate taxpayer to that number, you would end up having to pay £5,400 that you hadn't expected to pay. And this is just looking at just this one scenario. So let's now talk about solutions when it comes to capital gains tax. What can we think about doing when it comes to our finances? Well, there are quite a few things to consider doing. And one solution is to try to crystallize your gains on an annual basis so that you are able to take advantage of the current allowances or perks or anything that's available as it's currently available right now before it gets taken away. The alternative, apart from trying to crystallize it, i.e. sell and crystallize your gains now, is that you can try and sell, but if you want to keep a particular asset for the long term, you can try and buy that asset back. However, there's a rule that says that you have to wait for 30 days for those gains to be crystallized before you're able to buy that asset back. However, given the time I'm making this video and the time, over which, in the next few weeks, within which, the Chancellor will potentially be making some changes, it might be too late to make this buyback if you wanted to do that, for example, because you wouldn't have 30 days available for you to wait to do it. Alternatively, if you wanted to, an alternative, for example, might be to sell an asset right now, a sellable asset, but buy a different asset entirely back immediately. So that's another way of doing it. You sell it, you crystallize it, and you take the current allowances that are available and you buy another asset back. Another way you could go about doing this from a capital gains tax perspective to prepare is to use up all your allowances when it comes to ISAs and pensions. At the moment, you get £20,000 tax-free allowance in your ISAs, and with pensions, you get £60,000 per annum you can put into a pension. However, there's a way in which you can go about doing it. It's a process known as a bed and ISA. So the bed and ISA is a type of transaction that involves selling investments outside of an ISA, say for example in a general investing account, and then being able to buy them back in an ISA without there being any problems. So this allows an investor, yourself or myself, for example, to take advantage of our annual ISA allowances and also to protect our investments from tax, not only now, but also in the future. Various providers are able to do this for you if you wanted to do it. Hargreaves Lansdown, AJ Bell, and various other providers are able to do this bed and ISA transaction if it's something that you wanted to do. Now, it's worth noting, because I did some research into this just to make sure I got this right, is that with a bed and ISA, you can only do it on the likes of ETFs, for example, or investment trusts or shares, but you can't do it on unit trusts and OICs, open-ended investment companies, or index funds. You can't do it on those. So it tends to be things that you can buy and sell on a stock exchange, like shares or ETFs and what have you, that you can do this process on. There's also a bed and SIP process that you can explore. If you don't understand some of these terminologies, feel free to just note them or pause, Google them and look them up. But the resources are available, online, for example. Now, other things you can do when it comes to capital gains tax is if you are married or in a civil partnership, consider transferring shares to your partner so that you can both use up your CGT allowances. So if there's two of you and you both get £3,000 each, that's £6,000 that you can both get as a way to offset some of those gains you might have generated. In addition to that, if you've got a partner who is on a basic rate, who's a basic rate taxpayer, or who's on a lower tax rate, for example, they may be able to pay tax at a lower rate of 10% because they are on a lower basic rate instead of the current 20% that you might pay if you were a higher rate or additional rate taxpayer. And the final thing I want to share when it comes to capital gains is don't forget about offsetting any capital losses. So if you've made any investments and you've got losses, you can offset those. If you have any losses, you can realize those by selling and then using those to offset against gains in the current year, as well as if you've used up all your tax-free allowances and then you've offset as much gains as you can also carry forward your losses against future gains. So it sounds like I've said a lot there. Feel free to, and I have said a lot, feel free to pause, reflect on it, go back at any point to just cover, almost replay some of the things I've shared there when it comes to what to do about capital gains tax. Now I want to talk about pensions because pensions is a very emotional topic. We're all thinking about retirement and planning towards it, but at the same time, there's a lot of uncertainty when it comes to pensions. So here are the areas that we feel, based on the research and looking at what's been said and what hasn't been said, here are the areas they might actually try to raise money from. The first is that the pension tax relief could be reduced and they could opt for a flat rate. So at the moment, if you're a higher rate taxpayer or additional rate taxpayer, it's very tax efficient for you to put money into your pensions. That's the first area. The second area is that pensions could become taxable if somebody passes away before the age of 75. At the moment, pensions are effectively a wealth transferring tool because a lot of wealthy people or people who've built up significant pension pots leave their pension pots to be passed on to family members without paying any inheritance tax. The third area they could consider raising money from is that they could reduce the 25% tax-free lump sum, currently capped at £268,275. Yeah, they could actually look to reduce that as another way of trying to raise money. I want to now look at each one of those in turn. The first one is income tax. Imagine if they changed the pension tax relief. Now, as I mentioned earlier, it's a huge incentive for people at the moment to put money into pensions because you get tax relief, particularly for higher rate and additional rate taxpayers. So, for example, at the moment, if you put £1,000, a pension contribution of £1,000 would only cost you £600 as a higher rate taxpayer or £550 as an additional rate taxpayer. However, if the government suddenly went, do you know what? We're being too generous. We're going to opt for a flat rate. Let's say they went for a flat rate of 30%. This will hit different people differently. Yeah. So for one group of people, the basic rate taxpayers, they will actually benefit from this because they're getting a higher tax relief. For higher rates and additional rate taxpayers, it will mean that they're actually losing money. So for example, if they did that and went for a 30% flat rate when it comes to tax relief, it would mean that a pension contribution of £1,000 would actually cost £700, yeah, rather than £600 for a higher rate taxpayer or £550 for an additional rate taxpayer. So it's actually costing them more to do it. However, the good news for a basic rate taxpayer, because the same contributions that would have cost them £800 being a basic rate taxpayer, if they went for a 30% flat rate, would now only cost them £700. Yeah. Now it's interesting. I saw some research according to the Financial Times. They said, and I was reading an article earlier, they said that, quoting the IFS, the Institute for Fiscal Studies, they said that tax relief applied at the basic income tax rate of 20%, so a flat rate of 20%, across all contributions could raise a whopping £15 billion a year. So you can already see how attractive it is for the Chancellor to try to do this. Yeah, even though, you know, they had actually set this up in the first place as a way to incentivize us to save for retirement. But you can see how, you know, in those offices where they're plotting what to come up with, they could be salivating at the idea of trying to take these reliefs away from people by putting in a flat rate. So what can we do about this? Now, if you're worried, about, what could happen potentially, one thing you can do when it comes to them potentially putting in a flat rate is to try to basically use up as much of your allowances as you can right now whilst you've still got it. Yeah. The second scenario is if pensions become subject to tax on death. Yeah. As I mentioned earlier, assets held in a pension, in a SIP, for example, or in any form of your workplace pension and what have you, it's currently not subject to inheritance tax, provided somebody obviously passes on before the age of 75. Now, imagine, and this would be a very, very difficult and very painful thing to do, if they suddenly went, sorry, I'm now going to put a tax on your pension if you pass away before the age of 75. Here's a scenario. Imagine that someone had, say, a pension worth £250,000 on top of their estate. Yeah. So imagine that they have an estate that is worth more than what they call a nil rate band. So the nil rate band is how much you're allowed for inheritance tax purposes, which is at the moment £325,000. So imagine on top of that, imagine you crossed that nil rate band, but you had a pension worth £250,000, and the government suddenly went, okay, normally we wouldn't tax you, tax that pension that you've got, but now we're going to now put in, as a higher rate taxpayer, a 40% tax as a result of that. That means that your loved ones in that scenario, who will be inheriting your pension at a time of death, will suddenly need to stomp up a whopping £100,000 of taxes to pay. This would be, and I get the point that this would be a great way for the government to raise money, but it will be it will be ridiculous for people. It will be insane. It will be like robbing people, basically, because you got them to put money into their pensions, and then suddenly you come in, come in a few years later and you change the rules, and suddenly you're trying to take their money away from them. And I read again the FT, and I quote them. They said here that according to the IFS, they estimate that bringing pensions within the scope of inheritance tax could raise up to £2 billion per year. So you can see that there's the incentive for them to do this. But is it morally right to do it? Is it really the right thing to do that? I know they can raise money doing it, but is it really the right thing to do? Well, let me know what you guys think. Now, when it comes to this idea that pensions might be subject to tax on death, what should you be doing right now, if anything, when it comes to solutions? As we all know, a pension is a great vehicle for planning for retirement. It's obviously not the only one. We talk about ISAs a lot on this channel. However, one thing you can consider when it comes to inheritance tax planning is to make sure you are considering gifting. So gifting is a way in which you can give away your assets over time, and reduce the value of your estate, therefore reducing how much will be subject to inheritance tax over time. So gifting is definitely one way to go about it. And there's a whole 7-year rule, and I'll touch on that later on when I talk about inheritance tax on this video. I want to talk about income taxes now. It talks about capital gains and pensions. Now, income taxes, they've said they're not going to increase any income taxes for working people. However, one thing I'm sure you've not forgotten is the fact that our personal allowances have been frozen since the thresholds have been frozen since April 2022. Yeah. So one thing, what this means basically is that, if you've got, income that's inflation linked, for example, the more you earn, the more you get pushed into higher brackets of tax. And as a result of that, effectively a stealth tax, you're effectively paying more taxes over time. Yeah. So given these thresholds are frozen and are likely to remain frozen, meaning that more people will be paying income taxes, what should you do about that? Well, one thing you can do is that if you have savings, obviously consider putting your money into an ISA where your money is a bit more protected from any future taxes. You may want to also consider exploring, a pensions vehicle. But although I talk about that, I'm also wary of the fact that although we may be putting money into pensions are also under attack in so many different ways. Now, one thing you can do when it comes to income tax, and again, this is more general suggestions, is that if you're married or in a civil partnership, and you've got a partner, as I mentioned earlier, who is on a lower tax rate, you can actually transfer income producing assets to your partner, allowing you both to therefore take up any taxable allowances, and for your partner also to be taxed at a lower rate when it comes to income taxes. It's a lot more tax efficient. Okay, let's now look at inheritance tax. All right, I feel like it's been a bit of a marathon on this video, but hopefully it's been worth watching so far. Now, potential changes when it comes to inheritance tax, it's quite a lot of areas they could target. The very first potential area is that they could make pensions, as I mentioned earlier, subject to inheritance tax if somebody passes away at the age of 75. That's number one. Number two is that the current new rate band of 325,000 could be cut. Okay, they could actually choose to reduce that amount and say it's too generous. Yeah, which would be a disaster for people who have been planning, planning for inheritance tax over time. The third way they could actually raise money is that you could no longer pass on your own nil rate band to your partner. Yeah, so couples can pass their nil rate bands between each other. They could say no. Computer said no, I'm taking that away. Another thing they could do is to reduce reliefs for things like business property reliefs. And agricultural reliefs, which are ways that, to be honest, quite wealthy people effectively use to exempt some of their assets from inheritance tax. Things like business property relief, they effectively cut down, how long you normally have to wait for your assets to be exempt from inheritance tax, can cut it down to 2 years, basically. People buy AIM shares and stuff like that, yeah? Then the fifth way they could do it is that they may introduce a single annual limit on gifting. They could combine all your gifting possibilities when it comes to inheritance tax and say, do you know what? I'm putting a cap on it. And that's it, yeah? Now, I want to just talk about some of these areas and what we may consider doing. So the first is, if the nil rate band is cut, that 325,000, as I mentioned, that's what we currently get at the moment, completely tax-free. And in addition to that, if you are leaving, and this will apply to you or your parents, if you're leaving your home that you live in to your children, for example, and I've been thinking about this a lot, obviously, with my parents as well. If they're living at home to their grandchildren or to their children, they also get £175,000 residence nil rate band. So what that means is, take that 325,000 and 175,000, combine them together, you get £500,000 altogether. That's as at the moment, before inheritance tax becomes an issue. So you can see why. When you talk about inheritance tax, people are like, oh yeah, it only affects a very small percentage of people. And it does. And that's because, the allowances are potentially generous. But then, as you know, asset prices have been rising significantly, effectively meaning that a lot more people will be paying inheritance taxes anyway. Yeah? So having that allowance of 500,000 potentially is very, very comforting for people, because they're like, you know what? I kind of have a bit of a plan and I can try to reduce my inheritance tax bill. However, here's how it could become difficult. If you are somebody who's single, and let's say you have no dependents, you have no children, and let's say that you have an estate that's worth, say, 325,000. In that scenario, you pay no inheritance tax. Great, my estate is worth 325. I've got the allowance. I pay nothing. However, if the government turned around and said, do you know what? We're actually going to cut that £325,000 to, say, £250,000. If they did that, then the nil rate band is lower by £75,000. In that scenario, if they did that, you would there'll suddenly be inheritance tax for your family to pay, i.e. they need to pay 40% of £75,000, meaning that they would have a £30,000 inheritance tax bill suddenly show up. The third scenario, as I mentioned, is if you can no longer pass on your nil rate band to a partner. Now, as I mentioned, at the moment, you can do that, but what if you can't? So at the moment, if you've got 500k, your partner's got 500k, you can combine it and you've got £1 million potentially as a tax-free amount off your estate. However, if they change that, imagine that you are married, and let's say you're somebody who has, an estate that's worth, say, £700,000. And let's say you've got a home worth, say, £350,000. At the moment, with the rules, how the rules are set up, you would currently not pay any inheritance tax. But if you currently cannot pass on your nil rate band to your partner, it will mean that on death, if your estate was worth 700k, they will suddenly have an additional 200k on which they could potentially pay inheritance tax, being 700k minus the 500,000. And if you take 40% of that additional 200,000, it could mean that you might have a bill of £80,000 suddenly show up as inheritance tax to pay. And there are lots and lots of things you can consider. Inheritance tax is one that I would say get some advice on. In our book, Financial Joy, in week 10 of the book, we cover legacy planning, inheritance tax rules, trusts, and writing a will, and all those various things. So I would say seek some advice. And if you bought a copy of our book, or if you're going to buy a copy of it, feel free to read week 10 in the book for some more guidance. But there are many things you can do at the moment, including the 7-year rule, where you can transfer assets, and if after 7 years you're still alive, those assets become exempt from inheritance tax. Overall, when it comes to inheritance tax, I'll say that the budget that's coming up should act effectively as a prompt. If you're one of those people who's been running away from talking about inheritance tax, or your parents been running away from it, this might be a good way to start a conversation internally at home, yeah? To get people talking about it and to get, families planning, thinking about, gifting and those sort of things as a way to reduce your inheritance tax liability for the future. Now, as I mentioned previously, I've only looked at some scenarios for what the government might explore as a way to increase taxes and so on. But this video has not attempted to cover every single possibility. And just saying that. However, we made a video previously, which I'll be linking to later on this video, where we talked about what if the state pension was actually means tested. But to conclude this video, I want to just wrap up by some, I took some time out to just reflect on these points after preparing for this video. I want to just reflect on a few things and really, like when I zoom out of all these numbers and all these scenarios, just zooming out of it for a minute, a few things that stood out to me, and here they are. The first is that the private sector is being significantly disincentivized by raising taxes on savings as well as gains, capital gains. Yeah, there's a big disincentive, which means if you're disincentivizing the private sector, you are effectively disincentivizing growth in the UK economy. That's point number one. Point number two is that encouraging people to save money, plan for their retirement for the long term is actually a good thing for the economy. It's healthy for the UK economy. One thing, and I hope they're doing this as part of the big pension review by the government, one thing that we cannot run away from is the idea that we have an aging population. I mean, I read recently this, only last week, that we have around almost 15,000 centenarians in the UK, so people over the age of 100 in the UK. But what was more interesting is that we have more than 1 million, just over 1 million people in the UK at the moment, in England actually, not even the UK, in England, who are over the age of 90. Like just think about that for a moment, right? So we have an aging population. So effectively, you can't, on one hand, have an aging population and then on the other hand be disincentivizing saving for that future that people know is inevitable, that they cannot run away from. Yeah, so that's my second point. So the government needs to really think about this. Their pension review and their budget that's coming up really needs to take into account the fact that we have this, this aging population, and what does that mean for the future of the UK? My third point is that I personally think it's incredibly sad, the hardworking people in this country effectively always have a sense of uncertainty when it comes to their retirement planning. And I'll tell you why. You know how when we talk about investing in the stock market, we say, oh yeah, your investments can go down as well as up, right? There's this risk warning that's saying, hey, look, you could lose your money, but you should also invest, right? However, one thing you might not have thought of is that there's actually a bigger risk. I personally think there's a bigger risk, which is the government risk that exists, which is that you are diligent, you're working hard, you're putting your money away, you're taking fewer holidays, you're working extra hours, you're saving for retirement in your defined contribution pension and your ISAs and what have you. And then suddenly, guess what happens? Somebody comes into power and they decide to dip their hands into your pocket. I think that's incredibly sad. That is the reality we have of life in the UK. There is always somebody, and it's a government risk, there's always somebody trying to take your money away from you. And that is a fact. It's a fact. There's no running away from it. But it's a sad fact. My fourth point is that I also think it's very frustrating that a lot of these initiatives or ways of trying to raise money are usually targeted at the private sector. A lot of people who have their DB pensions in the public sector, nobody says very much about those guys. They're like, yeah, man, you got your gold bar pension, no one's touching that, you got your DB pension, and that's good for some people. However, why is the target always to the private, to the people in the private sector with a DC pension who are even struggling to raise money, to save money for their retirement? I just think there's an imbalance there that's probably worth discussing. And then his final point for me, it's probably my biggest point, which is that aspiration is punished in the UK. That's a fact. I just feel personally, I just kind of zooming out from all this, I just feel like there is a lot of kind of like envy / scarcity thinking that I feel is almost built into the fabric of the UK, kind of the mindset in the UK. That means that people who are working hard, putting money into their pensions, a lot of those people who are putting money into their pensions, they didn't win the lottery. They're not putting that money in from some free money they've received. They're putting that money into their pensions from money they've been saving. They've made sacrifices. They've delayed gratification. Like I mentioned earlier, they've taken fewer holidays. They've worked extra hours. They've just gone above and beyond. They've worked very, very, very hard. However, they still get punished. Rules still get changed. And the rug still gets pulled from underneath their feet. And I think that's a very difficult reality to accept. I personally really struggle with it. And I wonder how you feel about that. In fact, I want you to react in the comments. Just jump in there and let me know. How do you feel about these final points I mentioned? About the fact that your aspiration is continually being punished by the government of the day and successive governments that come into power. Jump in the comments and let me know what you think. Now, to wrap this video up, I want to link below over there somewhere to a video you might want to go and watch right now, where we looked at the possibility of the state pension being means tested. Again, a very emotive kind of topic, very, very difficult topic to explore, but one that I think you find interesting and one that some people actually argue is inevitable. Thank you guys so much for watching today's video, and as always, in all things, be thankful and seek joy. Take care and bye for now.